what we're going to be looking at here is impairment of long-term assets. Now, an asset, you can either hold it for use in the future or you can intend on disposing of it here. But for our example here, we're going to be looking at an impairment of assets that are going to be held for use here. So we're going to be using it here in the future here. And we're going to just go through a simple example here. So we have this equipment here on 12/31/20X1 that we are going to, or it's held here for use in the future here. And what we're given here is our equipment cost of $18,000 less our accumulation of $2,000 here that we have on it gives us a book value here of, or carrying value of $16,000. And now we have to determine the two things here. The future net cash flows, well, that we're given here at $14,000 here for this asset. And then the other thing we have to determine is the fair value or the fair market value here of this asset. And that we're given here at $8,800. So now, knowing these items here, we've known that we've had some significant changes here in this asset, and we have to test to see if it fails this recoverability test here. So how we test that here is we look at the future net cash flows of this asset, and then if it's less than the carrying value, then it's going to have failed this recoverability test. So our future net cash flows of $14,000 here are less than its carrying value here of $16,000. So we've failed our recoverability test. Now, based on that, we can determine an impairment loss here. So we do that in this fashion here. You take the book value or the carrying value here of $16,000, and then you subtract here, or you compare it to the fair value here. So subtract the fair value here of $8,800 that we have on this asset, and that's going to give us the impairment loss here of $7,200. So you can see our fair value here of $8,800 is less than the book value, the carrying value here of $16,000. So that gives us our impairment loss here of $7,200, and we'd be recording this on 12/31/20X1. So again, our loss on impairment, $16,000 book value less the fair value here of $8,800 gives us $7,200. Now, because we're assume that we're going to be using this equipment in the future, we have to recalculate the depreciation expense here, and that we do here by taking our new carrying amount, which is the fair value here of $8,800, and then we divide it by, in this case, the useful life that we estimated here to be 4 years. So we're going to get a depreciation expense per year here in the future of $2,200. So our depreciation expense here in 20X2, the next year here, would be $2,200. Now we've got we reevaluate these assets each period here. So, and we've done that here for 20X2, and we determined that we have an increase in our fair value here. So for our fair value here in 12/31/X2, it's now $10,200 on this asset, and we compared that to our fair value here in 20X1, or the previous year here, and that was $8,800. So the difference here, we see we have an increase in fair value of $1,400. Now, with this impairment here of assets that are held for use here in the future, restoration of any impairment loss is not permitted. So we've had the increase here in fair value, but we wouldn't restore it here because to our asset here, because again, because it's held here for use in the future, restoration is not permitted. So let's go and look at how we'd record this entry here. So we have our accumulated depreciation here in our balance sheet. We would credit that here for $7,200 for this impairment loss here. And then on our income statement, the impairment loss here in 12/31/X1, we would debit that here for $7,200. And then for this depreciation expense here for 20X2, we would be crediting our accumulation depreciation here account for $2,200. And then we'd recognize the depreciation expense here on our income statement here, 20X, and the 20X2 here for $2,200. And then remember here, there's no restoration of impairment loss here because we're holding this asset for use in the future. Okay, so now let's go and let's just do a review of this here, and we'll do it just in terms of definitions here. So okay, first off, the steps to determine whether there is an impairment here. So number one here, you have to review events or changes in circumstances for possible impairment, and we'll look at those below here. Number two, you perform a recoverability test. Now, if the sum of the expected future cash flows undiscounted, these cash flows here undiscounted, is less than the carrying amount of the asset, then you have two things here. A, you either fail the test here, that's where the future net cash flows are less than its carrying value here, then you would recognize an impairment loss here when you fail the test. And then no impairment here, that's if future cash flows here on this asset are greater than its carrying value. Then you wouldn't have any impairment here, and you wouldn't recognize any impairment loss. And number 3 here, if the recoverability test indicates that an impairment has occurred, then a loss is computed in here, and this is how we had that done here. We have our impairment loss is the amount by which the carrying amount exceeds its fair value here. So the fair value is measured based on the market value, and if no active market exists, then use the present value of the expected future cash flows to determine the fair value here. So this is where we take our carrying value here, subtract or compare it to our fair value, or subtract our fair value from it, and the difference here would be the impairment loss here. So just remember here, if there's no active market, then you have to discount the present value of the expected future cash flows. Otherwise, you'd use an undiscounted amount here. And then finally here, again, recognize impairments. What we're talking about in this our first step here, where we have to review events or changes, what we'd be looking for is significant changes. And these are the significant changes here that I've listed here. 1, significant decrease in market value of the asset here. Number 2, a significant change in the extent or manner in which the asset is used. Or 3, a significant adverse change in any legal factors or business climate that affects the value of the asset here. And then number 4, an accumulation of costs significantly in excess of the amount originally expected to acquire or construct the asset here. And then number 5 here, a projection or forecast that demonstrates continuing losses associated with the asset. So this list here is the significant changes here, where we'd be reviewing the events or changes for possible impairment. And so we went through our example here where we look at an impairment of a long-term asset, and we did it based on this asset that's being held for use here.